It doesn't matter if you're talking about the growth portfolio, the dividend growth portfolio, or any of my other investments alike. Because if you look across the board, like these 4 growth investments, or if you look at these other 18 dividend growth stocks, across the board, every single one of them, these are companies that we're investing in based off of their fundamentals. We're not worried about investor hype, investor sentiment, people getting excited, fearful, greedy, anything in between. We're looking for companies that actually have growing fundamentals. It doesn't matter what business we're looking at. If we're looking at a company like Salesforce, my largest investment, it has a company that is compounding revenues quarter after quarter after quarter with long-term growth of profitability by looking at its free cash flow. Or if we're looking at a dividend stock, let's go to one of my conservative dividend companies. If we look at a stock like Pepsi, one of my favorites, I'm drinking a Mountain Dew right now. Look at its long-term compounding growth. In terms of its top-line revenue, it's grown in the last 10 years at a 1.8 compounded rate, and its profitability has done a little bit better at 2.23%. Now, the company that we're talking about today, the company in question, is not nearly like one of these compounders because it is a compounder. It is growing very nice. If you look at its growth, it is stellar. It's one of the stock market darlings of the last decade, and its stock price can show just that. If you look at the last 5 years, this company's still up 419%. In the last 10 years, it's up 4,800%. The company, if you haven't figured it out already, is Tesla. Tesla is a company that hit new lows today, multi-year lows in fact, because while we look at this chart, you can notice if you look on the 1 year, it's down 70%. If you look at the last 2 years, it's down 51%. And if you look at the last 5 years, you can see that while it's still up significantly, it has given away multiple years of gains. The last time we saw this company trading around $100 was literally around its pre-pandemic lows. It's actually about to drop below that, going to about 2019 levels. Now, this company has been a phenomenal stock and an even better business, but we're going to talk about, for the first time ever, Tesla is not going down because of investor sentiment. They're going down because of fundamentals. So we're going to talk about that in this video and what exactly is going on with Tesla stock, and am I going to be shorting this company again? Because if you look here just 3 months ago, this video that says why I shorted $11,000 worth of Tesla stock and then closed it shortly after, where I talk about the profits that I took, we're going to discuss whether or not I end up doing that again today and how this affects the market in general. Thank you guys so much for tuning in, and let's go ahead and get started with Tesla stock. But before we get into all that, we have to talk about today's sponsor, MooMoo. MooMoo is a new up-and-coming brokerage that is taking the world by storm. Commission-free trading, level 2 data, advanced technical indicators, earnings calendars to see the date of financial statement releases, and institutional tracking to follow Warren Buffett's portfolio are just a few examples of what MooMoo has to offer. With this being my first sponsor in the channel, I have fully vetted their company and stand behind their vision. MooMoo currently trades on the NASDAQ under ticker symbol FUTU for FUTU and is SIPC insured. If you sign up below using my special referral link, you can get anywhere from 1, 10, or even as high as 20 stocks for signing up when you use my special referral link down below in the description or in the pinned comment down below. Free stock amounts can be as high as $1,000, so sign up now using the link in the description or pinned comment down below. You would help support me and my channel by doing so and give yourself an edge in the world of investing. Thank you so much, MooMoo, for sponsoring this video. Now back to the content. Okay, so for starters, if you guys didn't know already, today we finished about flat at $35,456. That's my current portfolio balance, and here's my returns versus the major market indexes so far throughout the first 11 months of 2022. We'll get the final results here with the last 3 or so trading days left of the year. Now, Tesla, you can see that Tesla is finally having some fundamentals reasons for going down. If you look at the stock price, let's go to the stock price throughout the last year or two, and you can see really around the time the company started to go down in value was when Elon announced he was going to be buying Twitter, and he would be selling Tesla stock to do so. Furthermore, Tesla started to get recession fears, growth rates started to tumble, and other things like China and their manufacturing. And speaking of manufacturing, we're finally starting to see real headwinds now. Not just rumors, not just estimates, but actual real fundamental problems that the company is finally experiencing now. Tesla to run reduced output in Shanghai in January, the plan shows. Tesla plans to run a reduced production schedule at its Shanghai plant in January. Extending the reduced output, it began this month into next year amid the internal internal schedule reviewed by Reuters. Tesla will run production for 17 days in January between January 3rd and January 19th. It will stop electric vehicle output from January 20th to January 31st, an extended break for the Chinese New Year. Now, it is common overseas for many Chinese companies to get an extended break because they celebrate hard on those New Years, but however, it is important to note that this is not normal because it goes on to the article saying that this is pretty much something that you've never seen from Tesla. And I think the real reason is because they're facing a demand lowering side from the consumer. If you look at this revenue chart, they've experienced massive revenue growth for a long time. Even in the most recent quarter, they grew 55.99%. Now, this may look great, this may look like a beautiful chart, but the big question is how many more electric vehicles will be getting purchased? If you look at wait times behind Tesla, you can see that there is starting to shrink dramatically, and the profitability, while it is holding up nice now, I question whether or not these margins will be able to maintain. Because if you look at the return on capital employed, it's been uptrending, the most recent quarter coming in at 7%. Their operating margins have been uptrending, the most recent quarter coming in at 17%, but I really wonder whether or not that will hold true. Something else I might mention as well, by the way, for Tesla, and this is the biggest drawback I've had, and the reason why I shorted the company was not even a fundamental problem. The problem was strictly valuation. Even now, as crazy as it is to say, let's look at this company's free cash flow. Last year, they put up $3.4 billion in free cash flow, and while that may look great, this is a $388 billion business. So just to give you an example, let's show that side by side from one of my investments. 3.5 billion, okay, and a $388 billion business. 3.5, 388. Remember those numbers. This company that I'm looking at right here trades less than half of the valuation. Actually, in fact, it trades at about a third of the valuation. And instead of 3.4 billion in profit last year, this company did 5.28, which is roughly almost half of what the company did in profit. So keep that in mind. This is what I consider to be one of the best businesses in the world. Salesforce, it's incredible. It's 1/3 the size of the Tesla with almost double in profit of what it did last year. Now, some people might say that, oh, well, Tesla's growing. It's growing much faster than something like a Salesforce, and that's true. And right now, as of the most recent quarter, it's still growing 55%. The big problem is I don't think it's going to continue that run. So the thing is, there's two main things that you have in investing that move stock prices. You have investor sentiment and you have fundamentals. And fundamentals are what drive long-term value, and sentiment drives short-term value. And in the short term, you can look at all types of things that affect sentiment, like buying out Twitter, like recession fears, like worries about stock price, fear, greed, and many other things that can affect share prices, as you can see from this huge uproar and then this huge downturn just in a short period of time. It's really shocking to see. But what really drives long-term fundamental value is these charts. Whether it's the revenue growth, whether it's the profitability growth, this is what you should look for as an investor. And another thing I might mention, something that's even more important that investors should be focusing on, is while this company does produce profits, and while this company does have a lot of cash on the balance sheet, as we can see here, while 20 billion may sound like a lot, it's not enough to buy any reasonable portion of the shares, because they can't even buy back 10% of the company with that. They can't even buy back 5% of the company if they were to use all their cash tomorrow. And speaking of which, buying back shares, this company is still heavily diluted. In the most recent year, they've diluted the shareholders by over 5%. That is pretty high. To give you an example in comparison, actually, we'll use Salesforce again because this stock of mine has been criticized very heavily for its dilution, and in the last year, they diluted shareholders 1.7%. Even I don't like to see this, and this is my biggest negative. This is my number one drawback for owning this company. This is the one thing short of it being perfect, in my opinion. Losing 1.7% of ownership every year really sucks. I couldn't imagine how much less enthusiastic I'd be as a shareholder if instead of losing 1.7% of shares outstanding, I was losing 5.08% annually. So that's something else to consider, and obviously, the only way that it can keep that market cap is if it keeps going up, because obviously it's diluting shares by the day, the recession fears are mounting up, they're reducing production in Shanghai, and then the CEO, well, I'll let you take your own opinions about that, but Elon, he's doing what Elon does. Elon does what he wants to do, so that's something to factor in there as well. Thank you guys so much for watching. Check out all the stuff down below in the description if you haven't already. Thank you, MooMoo, for sponsoring this video, and I'll catch you all next time.